Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Satoshis Live, where we talk about everything happening in the crypto market, which has not been great lately, if you're paying attention. Certainly a lot of negative price action in the last few weeks. It's interesting, last week, maybe mixed earnings from tech giants, mostly pretty positive, actually, outside of Facebook or Meta. Overall, third quarter earnings have been fantastic. Slightly hawkish Fed, despite getting the anticipated 25 basis point rate cut. Certainly a little bit of jockeying with regard to what that means for December and thereafter. Market starting to price in a little bit less of a fast trajectory of rate cuts, which has in turn led the dollar to turning higher. Maybe marginally driving weakness in crypto, although you're not seeing it nearly as much in equities or in rates. Probably the biggest news, just the changing of the guard we continue to see. A lot of data from some of the biggest data providers who are wallet trackers, talking about some big Bitcoin sales from some of the bigger crypto OGs. These are guys who have been around for 15 plus years, some of which have, billions of dollars worth of Bitcoin starting to sell. And honestly, it's impossible to know what's driving that, right? Is that because these people are just libertarians and the idea of governments and corporations getting involved in Bitcoin is just unsatisfying to them? Or is this because they truly believe in 4-year cycles? Or is this because they're just on life-changing amounts of money and don't care anymore? Who knows? But what's interesting is that, if you go back 5 years ago, I remember when the big Bitcoin miners and some of the bigger, old school whales of Bitcoin, they would go out there and just buy a ton of puts on Bitcoin. And then they would go and start to dump their Bitcoin with the idea of making all of the money on the puts after they sell it to basically limit any slippage, because they would drive the price down 30, 40, sometimes 50%. Now you've had, tens of billions, if not hundreds of billions of tokens being sold from some of these bigger early adopters of Bitcoin, and Bitcoin barely budges, right? I mean, we're talking about less than 20% from the highs and still up 10% year to date. So it's an interesting dichotomy that we're seeing, where some of the older cypherpunks are gone and being replaced by some of these ETF buyers and some of these corporations, and maybe even soon one day central banks. So I think that's pretty interesting, just how this market has changed and developed. Obviously, that has done nothing for the broader crypto market. You're not seeing any maturation at all in the price action or in the investor base of other assets beyond Bitcoin and ETH. But you certainly are seeing a maturation process in Bitcoin specifically, and how easily some of these sellers have been absorbed. The other thing last week that I think is interesting is, we've been on record many times talking about these ETFs being, sort of a double-edged sword. On the one hand, it's good that you're bringing crypto to a new audience in the equity market. On the other hand, it makes absolutely no sense to jam a T+0 real-time settlement instrument with features far superior to stocks into an antiquated, T+1 ETF box. It really just does nothing for crypto rails, right? You want to see activity on crypto rails, not crypto assets being driven to non-crypto rails. So I think these ETFs, again, are sort of a necessary evil, but they don't really do a whole lot for the overall growth of blockchain. But we did see another big ETF launch last week, this time Solana, as well as some other smaller ones. The Solana ETF attracted $116 million in inflows in the first week of trading. You can imagine some of the other smaller ones like Hedera and Litecoin showed little to no activity at all. But this Sol launch was a pretty deal in terms of the volumes that it's still attracting. So again, there's a real big difference in crypto right now between the haves and the have-nots. The have-nots, just no bid, being supported by market makers. You can see everything from the October 10th crash to just daily volatility, that there's just no real bid for a lot of this stuff. But there are still a handful of assets here that Wall Street and retail equity buyers really still enjoy, and it looks like despite the negative price action for Solana, I mean, this has been one of the assets that just can't catch a bid at all, down 30-some% now over the last 2 months, and down 20% now for the year. But still, despite the price action, clear that there is still at least some recognition of that asset and some demand. Lastly, I think this is probably another thing that just gets swept under the rug. Like, too many people in the media, too many retail investors really just focus on price action. But there was 2 token holder friendly M&A events last week that I think are pretty important. We've always said that equities really don't protect you as much as people think. Yes, you have Delaware law. Yes, you have real legal rights to, the assets in a bankruptcy. But by the time a company actually goes into bankruptcy, usually it's the debt holders who get all the assets, and the equity holders are left with nothing anyway. So it doesn't really protect you as much as you think. And we've always said the token holders are just as good on the way up in terms of capturing value, and there's probably not nearly as much downside on the other way as well. We saw two examples of that last week. The first was Pump.Fund made its first ever acquisition, funded by the $1 billion plus corporate war chest that they have due to organic cash flows from their core business, as well as the Pump token raise that they did earlier in the year. They announced an acquisition for an on-chain trading platform called Padre. And at the time of the announcement, the Padre token had a really small market cap, only about 5.5 million, true micro cap compared to Pump.Fund's $1 billion plus market cap. The Padre token rocketed higher immediately by over 2x in a few minutes upon news of the acquisition, but then it crashed down 90% because there was no details on how Padre holders were going to be recognized in this transaction. So Padre holders and the crypto community at large started to slam Pump.Fund and the Padre team for failing to protect Padre token holders. But as expected, Pump.Fund came out a few days later and said they had taken a snapshot of all Padre holders just before the announcement, and that they were going to give each holder on record an equal amount of Pump tokens. So basically, this is just a voluntary M&A transaction where Pump.Fund did the right thing and said, we're going to take care of the Padre holders via this acquisition. And that makes sense, right? Because the whole point of crypto ownership and tokens is the coordination and alignment between founders and token holders and customers. And it would make no sense to just buy another company and then have all their customers and all their investors pissed off and leave. So it makes all the sense in the world to make whole the token holders of a company that you're acquiring here. So, we think this is a pretty interesting takeaway. And we certainly think that this is the norm that will be set for any other acquisitions that we see in the future. So pretty good move by Pump.Fund, a great outcome for Padre holders, and another example of alignment. We saw something similar with Clanker as well. A token launchpad on the layer 2 base was acquired by Farcaster. Details around the acquisition are sparse, but we do know going forward that all fees collected by Clanker will be used to buy and hold the Clanker token. So in addition, all Clanker previously collected through fees were burned, and the Clanker team's own token holdings are locked in an LP pool to increase token liquidity. So Farcaster does not have a token yet, although we do expect one to be launched at some point. But the terms of the deal, are probably not finalized yet. But it is notable that, again, the Clanker token was up 120% since the acquisition announcement here. So again, another example here where there is an actual end game here. There is an actual terminal value here for tokens, and they get taken care of, in similar ways that equity holders do. So we've always felt pretty strongly that this idea that you're super protected because of simply being an equity holder doesn't really carry that much weight. It's a hypocritical and often lazy argument. We just haven't seen that many examples of token holders being positively affected, but it's going to start coming, especially if this weakness in prices continue. And it's good to see that two of them last week were both positive for the underlying token holders. So that's it for this week. Check out the blog if you want to read the whole blog, as well as see some underlying charts and graphs to support the arguments. And we'll be back again next week. Thanks, everyone.